From the morning reading, traders in the RightX family of mutual funds have panicked to the greatest extent in 20 years. They've shifted more assets out of the bullish index funds and into the bearish inverse funds relative to their long-term trends. Such panic has usually resulted in positive stock returns. Market breadth has been even more volatile than the indices would suggest. The ARMS index, aka trend, was above 3 on Tuesday but less than 0.6 on Wednesday, showing a huge shift from the downtrending stocks to uptrending ones. Such back-to-back reversals have occurred 23 times in the past 50 years. Short-term performance was mixed going forward, but by 6 months later, the S&P was higher 74% of the time, averaging plus 8.8%, and a year later, 9 months later, 87% of the time, averaging 13.3%, and a year later, 83% of the time, averaging 15.8%. So, bottom line, if you have a longer-term view, many of these patterns would be with their highest probabilities expected to resolve to the high side. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:33 a.m. Central Time, and I'm recording this in preparation for the market day of September the 3rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our overnight action. And we have on all four of the broad market indices for the United States a positive night, with the S&P up about 0.35%, Russell up about 0.2%, NASDAQ up about the same as the S&P, 0.35%, as is the Dow. Crude oil was essentially scratch. The euro down just a tiny bit. The bonds were up about 0.2, and gold down about 2/3%. In overseas action, the China market was closed, as is Hong Kong. And then Japan was up about 0.5%, Germany about 1.5%, United Kingdom up about 1.4%. So quite a bit of robust bullishness coming out of Europe. In terms of macroeconomic reports for today in the United States, you have unemployment claims on the weekly version. You have ISM non-manufacturing PMI, and then also the natural gas report. Tomorrow you have the big monthly employment report, so look for that. And then let's see if there's anything else. Oh, you have an FOMC member speaking early tomorrow morning, lacquer, so kind of be aware of that. Might throw a spin into your trading. In terms of volatility, we still have relatively high volatility. The short-term VIX is at a 24.26. Skew still up over a 125. And we had standard deviation moves put in on all four broad market indices yesterday. And you see that while some of this is starting to age off in the last 2 weeks, we still have a significant number of standard deviation days and a significant number of more than one standard deviation moves. So quite a bit of volatility that has been present in the market in the last couple of weeks, including the last couple trading days. In terms of IV percentiles, we're right back to the kind of the midpoints. We're at 50 on the S&P, 47 on the Russell, 51 on the NASDAQ, and 61 on the Dow. In terms of our regular daily report, we're still looking at phase 2 or trend breaking, so not a great place to be putting on new bullish trades. IBD status remains market in correction. Accumulation distribution for the S&P is a D, and NASDAQ an E, so still very ugly there. GMI index also ugly at a 0 out of 6, and that author is in cash. Primary market condition is a neutral bull. Decision point scores still the same as yesterday. but that would be, of course, lots of down red arrows, so very, very poor conditions being represented by that metric. Intermediate term market posture remains weakly bullish, so that is one bright signal. And indeed, you'll see that the numbers hardly changed from yesterday at all, but you do have the S&P at a 36, the Dow at 39, Russell at 28. The NASDAQ actually, this should be just right out bullish instead of weekly bullish. It just barely crossed that 50 threshold. So, you know, from this standpoint, these are relatively friendly scores for the intermediate term. In terms of our overall hedge warning status, we have it still as level 3, crash warning, and number of things coming back and forth with this respect. We still have a market in decline warning being flashed on one of our volatility metrics, and then the VIX is still up over an 18. Distribution day count remains very high. VIX phase has been increasing, though the last couple days has ebbed a little bit. Skew is still high and is in a warning status. You did have with the New York Stock Exchange yesterday new highs, new lows. The new lows 143. That is you know, fairly benign. Nothing really of note there. And on our intermarket risk aversion indicators, 4 out of 5 are risk on at this point. So also some moderation coming in from that standpoint. Overall special opinions, still on option income strategies, we're saying that VIX is outside the acceptable windows. Not a good time to be putting on new option income strategies unless you're super nimble and aggressive and able to handle explosive volatility that could come in to the marketplace at any time in these kinds of market conditions. Cover call strategies, would recommend legging into those through put selling probably, and then also consider your position size. So but for new traders, novice traders, probably not a good idea. Only for very experienced traders putting on new positions in this kind of market condition. Put selling, much the same thing as covered calls. Consider for aggressive traders, and look for those bottoming patterns. Consider scaling in. Consider using spreads to be able to define your risk. So not very pretty conditions for any of the initiation of new positions. And you see from a sector market posture, it cannot get more red than that. It is ugly across every single sector, across every single time frame, and really any kind of bullishness in this kind of setup would be expected to be a counter trend move. Counter trend moves are statistically much lower probability of being successful, and as such not really friendly for taking new positions. Yesterday was a positive day with technology up 2.62%, industrials also, and consumer discretionary, and we'll call healthcare, you know, all 2% or better, and that actually is giving for a positive week for the last 5 days in those areas. But you see the 1 month, the 3 month, the year to date, and if these overall market postures play out, you know, you could give away these small gains that you've had in recent days very, very, very quickly. So that should be enough for today. Not a lot of changes from yesterday, but as always, of course, if you find what you're getting here is useful to your trading, we appreciate you liking us on your YouTube and subscribing to the YouTube channel that we've provided for you, or retweeting us to your Twitter followers, your StockTwit followers, Goodify, etc. More information is available about what we do in actually taking these principles and modeling those principles within our trading activities. Just take a look at that website. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. And we will see you back here tomorrow morning for the market preview from Falcon Global. Good trading.